Well, welcome back. Hope you enjoyed your break. Happy to have you back with us. I'm still your host, Dr. B. I didn't go anywhere. We're going to talk about partnership accounting. Partnerships. The word partnership. What is a partnership? What does that mean? What's a partnership? Who can tell me? What's a partnership? What does it mean to have a partner in business? In business. What's a partner? What does it mean to have a partnership? Don't you all answer at once now?
Um,
What are you thinking?
running, being co-owners and like running business together.
Yeah, 100%. Exactly. Yeah, co-owners. So let's say Johnny and Nick decide to open up a business together, and this business they're going to be partners. Now they didn't come in equally; they each bring something into the business, but those things might be different. Yeah. Well, one of you might bring in some assets. Another one might bring in some cash. Some might bring in equipment. But they form a partnership. They say, "Hey, all right, we can work together. We can do this business." That's a partnership, exactly. So they're co-owners in the business. That's exactly what a partnership is. And so we're going to talk about the different kinds of businesses that partners will form. We'll talk about the pros and cons to each type of business, and we'll also talk about how to allocate and record things like income and loss and owner's withdrawals, and we're going to walk through the partnership cycle. So partnerships are part of a form of a business. Yeah? In a partnership, we go through the formation. We got to create the partnership. So let's say Johnny and Nick want to form a business, and in this business they're going to sell some stuff. I don't know. So they got to form the business first. So they go, okay, well, how do we form a partnership? So first, Johnny and Nick, they got to agree to the partnership, and they do this through what's called a partnership agreement form. And in this partnership agreement, it outlines exactly what both partners are bringing into the business, assets, liabilities, equity. It outlines the agreement of who owns what percentage of the business, and it also identifies the business life cycle. Okay, business life cycles are what we call limited life. The partnership might have what's called limited life. The partnership can start and end with the agreement. Okay, it started with a partnership agreement. Its life is limited. The business could end if either Johnny or Nick retires, one of them passes on, or if they decide to dissolve the business entirely. Okay, that's why it's said that partnerships have a limited life. A partner passes on, a partner retires, the partners decide to dissolve the business. So the partnership has a limited life. Or they might sell the business, to someone else. All of those things are possible. That's why partnerships have limited lives. Here's the kicker: partnerships have unlimited liability. Oh, man, yeah, that part sucks. So here's how that works. Let's say Johnny and Nick, they get into this business, and unfortunately, one of their customers gets hurt. They trip and fall in the store. Oh my God! Customer destroys their back. Yeah. So unfortunately, what that means is the customer doesn't only sue the business that Johnny and Nick have, the customer sues Johnny and Nick. Okay, that sucks. But the thing is, with partnerships, there's unlimited liability. So if a customer trips and falls at Johnny and Nick's store, the customer doesn't only sue the business, they sue Johnny and Nick personally. And so that means that all of Johnny and Nick's assets, their houses, their cars, their retirement accounts, savings, whatever, all of that's up for grabs. Yeah, that's the thing. Unlimited liability. That's why you got to protect yourself. That's why every time I do a partnership agreement, I always do an LLC, limited liability partnership. Exactly. Johnny and Nick might go into this store business, right? That they're going to open up a store, and they could both own the property, right? They could both own the business. Oh, they could both own the building. They could both own the equipment in the building. Yeah, that's a co-ownership of property. That's a possibility. Now, usually when there's a partnership agreement between Johnny and Nick, there could also be a mutual agency, meaning that there's mutual exclusivity within the business. Now, this also means that Johnny and Nick are liable for the taxes of the business. That tax liability isn't always even. It's usually based off of the percentage of ownership in the business. And their agreement to be in the business could be on a voluntary basis. Now, when he forced them to be in the partnership. Well, Dr. B did, but that's besides the point. So there's a couple of characteristics to a partnership business. There's what we call a limited partnership, or an LP. This usually means that the partners assume management responsibilities and unlimited liability for partnership debts. There's that unlimited liability word again. They might not have personal liability in the business. What I mean is, with a limited partnership that Johnny and Nick agreed to, if they decide to do a limited partnership type of business, they're both liable for the liabilities in the business, but they won't be liable personally if someone sues them. That's a limited partnership. Or they might decide to do a limited liability partnership, LLP. This is a good one. Okay, let's say the business that y'all are in, it's a consulting business. Okay, this type of business, an LLP, protects the partners against any type of malpractice or negligence claims. You The only thing is, in most states, all the partners are held personally liable for the partnership debts. So all of the liabilities that come into the business, the partners are responsible for that, but they're protected against any type of malpractice. If the business is pretty big, let's say there's a whole lot of partners involved here, so it's not just Johnny and Nick. Lonzo might be in that business, Dua might be in that business. So the four partners get together. They might decide to create what's called an S corporation. An S corporation is if the business has less than 100 employees, it's treated as a partnership for tax purposes, for income tax purposes. It has the same liabilities, limitations, as a C corporation does. Or the partners might decide to form a limited liability corporation, LLC. They have the same liability features as a corporation, and the liability is limited. So they decide to go with one of these 6 types of business. My recommendation is typically to go with a C corporation. The reason for that is because you're personally protected against liability, and the business is taxed as its own entity, With a C corporation, the business is taxed as its own entity. The business itself acts as its own person, which is kind of nice. But in most cases, partners don't always agree with a C corporation, so they might go with an LLC or or a limited liability partnership or just a limited partnership. Again, it's important to make sure that your personal assets are protected, and so you want to make sure that whatever business you decide to go with for the formation of your partnership, that you have a limited liability. So let's say you agree on the formation of a partnership. The partners will invest both assets and liabilities into the partnership. So let's say, for example, that Johnny and Nick decide to open up a business together. And so Johnny's got some cash in the bank, Nick has some equipment, and then let's say Nick decided to take out a loan. So Johnny's bringing in some cash, Nick's bringing in some equipment, and Nick's also bringing in a loan. So Johnny, the cash is an asset. Nick, the equipment's an asset. But Nick, the loan is a liability. But you're bringing all of those things into the business together, into the partnership. The assets and the liabilities are recorded at market value of the contributed assets and liabilities. So let's say Johnny brings in $20,000 in cash. It gets recorded as $20,000 in cash. Nick brings in a piece of machinery that he bought originally for $50,000. It's currently worth $30,000, so it gets recorded at $30,000. And Nick's also bringing in a $20,000 loan. So it gets recorded at their values at the time that they're brought into the business. The asset contributions increase the partner's capital account, and any withdrawals will decrease their accounts. The net income or loss that's occurred at the end of each accounting period is allocated to the partnerships according to the partnership agreement. Now, if one of the two partners has a higher percentage ownership than the other, it's based off of those percentages that are written in the partnership agreement. So, we got two partners. We got Johnny and we got Nick. So Johnny and Nick decide to agree, and they are selling skateboards. Okay, that's their business, skateboards. So they open up a shop to sell skateboards. That sounds cool. They call it boards. Yeah, it's cool. So Johnny brings $7,000 cash into the business. $33,000 facility, and no payables for $10,000 on the I'm sorry. He brings in also a note payable of $10,000 for the business, and Nick brings in $10,000 in cash. Okay, so Johnny, here's the thing: you brought in $7,000 in cash. You brought in a building, $33,000 worth. But you also brought in a loan for $10,000, and so your current paid-in capital account is going to be $30,000. Now, here's we got 30,000. Here's how we got the 30,000. I can hear you, Johnny. It's okay. But let me explain it to you. You brought in $7,000 in cash. So assets, 7,000 up. You brought in the building, 33,000 up. So you brought in $40,000 in assets into the business total, Johnny. But you also brought in a loan of $10,000. So that means your total paid-in capital is $30,000. It's the $40,000 in assets minus the liability of 10. That gives you a paid-in capital of 30,000. Make sense? Good. You okay with that? You all can hear me? Everyone understands how we got paid-in capital 30,000 for Johnny? Yeah? Okay. I'm gonna pretend that was a yes. Now, Nick, on the other hand, he brought in $10,000 cash. So we debit cash 10,000 and we credit his paid-in capital account for 10,000. So the partnership is formed. Now, as the partnership goes on, the two owners, Nick and Johnny, might decide to take some money out of the business to pay themselves. We call that owners' withdrawals or partners' withdrawals. And that is taken out of their capital accounts, respectively. At the end of each accounting period, the net income amount on your income statement, at the end of your income statement there, your net income amount gets closed out through the closing process. You remember the accounting cycle, right? So through the closing process, we close out the net income to the owner's accounts based off of their percentage of ownership. So since Johnny brought in the $40,000 in assets, minus the 10,000 liability, so 30,000 Johnny brought in, and Nick brought in the 10,000. It's safe to say that Johnny would own about 60% of the business, maybe 70% of the business, and Johnny and Nick would have the remaining 30%. So they would earn the respective net income or loss, if there's a loss, based off of their percentage of ownership. Each partner's withdrawal accounts are closed out at the end of the accounting cycle to their separate withdrawal accounts for each partner. So the partners, Johnny and Nick, are not employees of the business. They are owners of the business. They don't receive salaries because they're not employees of business. They're owners. But they do receive the net income of the business based off the percentage of ownership. And that is how we divide the income or the loss to each partner in the business. There are three methods that we can use to allocate the income or the loss to each partner. One is called stated ratios. The other one is the capital balance based off of their capital balance accounts. And the third method is by their services they provided, the capital accounts, and the stated ratios. You can use all three. Most commonly, it's usually based off of the stated ratios or the capital balances. Those are usually the easiest methods. So stated ratios. Let's say that Johnny owns 2/3 of the business. Because remember, Johnny brought in $30,000 in capital. 40,000 assets minus the 10,000 liability, so 30,000 total capital. Yeah. And Nick brought in 10,000 in capital. Yeah. So 30,000 compared to the 10,000. So at the end of the first year of business, the partners earned $60,000. Okay, in net income. Okay, great. So Johnny owns 2/3 of the business. Nick owns 1/3 of the business. So we need to allocate based off of the net income. So net income is 60,000. 60,000 times 2/3 is $40,000. So 2/3 times 60,000, $40,000. And would go to Johnny, and then Nick would receive $20,000, which is 1/3 of 60,000. So we debit income summary, which is the net income, closing it out. We close it out to the paid in capital accounts for Johnny and Nick. So remember, Johnny brought $30,000 into the business. The 40,000 minus the 10,000 on liability, so 30,000 is his balance for paid in capital. His ratio is going to be 75%. For Nick, he brought in $10,000 into the business. His ratio is 25%. Where we got the ratios is the ratios are allocated based on their beginning capital balances. So if the total amount that the two partners brought in was 40,000, that's 100%. So we take their balance divided by the 40,000. That gives us the ratio. And so to allocate the net income, the 60,000 net income, we take the ratio times the net income to give you the allocation for each partner. Johnny would receive 45,000 and Nick would receive 15,000 if they decide to use the ratio method. And the journal entry would be debit income summary, 60,000, credit Johnny, 45,000, credit Nick, 15,000. So Johnny and Nick agree based off of their partnership agreement. Johnny will receive $36,000 for an annual salary allowance, and Nick will receive an annual allowance of $24,000. Each partner is allowed an annual interest allowance of 10% based off of their beginning capital balances. And any remaining balance of income or loss is allocated equally. So we would divide that by 2, yeah? So let's say at the end of the first year, we have a net income of $70,000. Well, we have to pay out their respective salaries first. Johnny wanted 36,000, Nick wanted 24,000. So we pay out their salaries first. So 70,000 minus the 36 minus the 24 gives us a remaining balance of 10,000. Then we have to pay out interest. It's 10% of their capital balance. Johnny had a capital balance of 30,000 and Nick had 10,000. So 3,000 to Johnny, 10,000 to Nick. That leaves us with $6,000 remaining after the interest is paid out. Remember, the remaining balance gets divided equally based off of the partnership agreement. So 3,000 to each partner. Now the new ending balances Well, I'm sorry. That means for the end of the year, Johnny received 42,000 and Nick received 28,000. Now let's pretend that instead of the $70,000 for the first year, we only end up earning 50,000 for our net income. Oh no, that's a $20,000 difference, right? Well, that's not going to work out too well. But here's how it works: we got 50,000. Johnny wants 36,000 for his salary, and Nick wanted 24,000. We still have to pay them their salaries. 50,000 minus 36,000 minus 24,000 gives us a remaining balance of negative $10,000. They also receive interest based off of their capital balances. Johnny receives $3,000 interest, and Nick receives $1,000 interest. Remember, it's 10% of their equity balances. Now, it just so happens that the partners share in both the income and the loss. If the remaining balance is minus 14,000, that means we have to take away 7,000 from each partner equally. That means Johnny will receive $32,000 and Nick will receive $18,000 at the end of the year.
Professor, can you repeat that last part just one more time?
Sure. So, based off of the partnership agreement, the partners have their salaries that they receive, and they have interest based off of their balance of their equity accounts. They also share in the income and the loss equally based off of the partnership agreement. So if the net income is 50,000 at the end of the first year, we pay out the salaries first. Nick gets Johnny gets 36,000, Nick gets 24,000. 50,000 minus 36 minus 24 is minus $10,000 balance. They still receive interest based off of their capital balances, according to the partnership agreement. Johnny receives 3,000 and Nick receives 1,000 based off of 10% of their balances. So the remaining balance is minus 14,000. Because the partnership also states that the partners share equally the income or the loss. In this case, they share in the loss. So that's why we have equal allocation of minus $7,000 for each partner. So at the end of the day, Johnny receives 32,000 and Nick receives 18,000. Does that make sense?
Yes, it makes sense. I just wanted to make sure I heard you right. So can we just assume when we face situations like this that business partners are both sharing the debt equally, unless it says otherwise?
Yes, in most cases, that's correct. Asia, you're right. So in most cases, that is true, unless it says otherwise. It's typically going to be stipulated in the partnership agreement. That's why that partnership agreement up front, when the business was first formed, is so important, because there might be a stipulation otherwise. But in most cases, you're correct. Each partner would share equally. Good point.
Thanks.
You're very welcome. So during the year, also, the partners decided to withdraw some cash from the business, to pay themselves. And that's fine. They could do whatever they want. It's their money. So they decided to do some withdrawals. So Johnny took out $20,000 and Nick took out $12,000 from the net income as withdrawals. So the way it works is they have their beginning balances. Johnny started with 30,000, Nick started with 10,000. And then we have the net income, then minus of net income of 70,000 minus the salary minus the interest and minus the allocated balance. I'm sorry, plus. It's just a plus. Salary allowance plus the interest plus the balance allowed gets us a total net income 42,000 for Johnny and 28,000 for Nick. So we add that to their beginning balance minus their withdrawals equals the ending capital balance. So their initial investments plus the total net income for each partner minus the withdrawals equals the ending capital balances. Now let's say Johnny and Nick got this great business going on and they reach out to their buddy Asia. And Asia says, hey, yeah, I'll join you guys in this partnership. And, but obviously Asia, she wants her cut. Okay, she's going to do this for free. All right. So she's going to say, all right, Johnny, Nick, here's the deal. I'll join y'all, but y'all going to pay. Okay, it's going to cost you. Asia will bring some money to the table into the partnership. So she's going to buy into the partnership. But she's also going to demand to be paid back over time, yeah? Of course. I would expect this. So there's a change. We're admitting a new partner. So Asia's going to join Johnny and Nick in the partnership. Until she's going to join the existing partnership until it's so the existing partnership gets dissolved when this happens. So Johnny and Nick say, okay, let's dissolve the original partnership and we're going to create a whole new one. So now it's Johnny, Nick, and Asia. So the three partners establish a new partnership agreement. The new partner, Asia, acquires partnership interest in the business by one of two ways. She can purchase a percentage of the business from one of the original partners. She could go to Johnny and say, hey, Johnny, you got 40%, you got 60% of the business or 70% of the business. Well, I'll buy 10% of the business from you. Or Asia can go, you know what? I'm going to bring my own cash into the business, or my own assets into the business. So she can buy in one of two ways. She can either buy a percentage of ownership from either Johnny or Nick, or she can invest her own money into the business. So let's say that Asia decides, you know what, I'm gonna buy into the partnership by buying shares of ownership from Johnny and Nick. So Asia buys $13,000 of ownership from Nick. Nick's like, yeah, that'd be great to have Asia as a partner in the business. So I'll let her buy in. Great, wonderful idea. So now we got the three partners. So Johnny started with the 52,000 at the end of the first year. Nick sold some of his ownership to Asia, $13,000 worth. And so Nick's new balance of ownership is 13,000, and Asia's the new partner, so she has 13,000 in her new balance. So the way that the transaction worked is Asia bought $13,000 of interest in the business from Nick. So the transaction is we debit Nick's account 13,000 and we credit Asia's account by 13,000 to represent the transaction between Nick and Asia. What she could have done is she could have brought some new cash into the business. She could have contributed to the business by bringing cash into the business. So the new assets would increase the partnership's net assets, the total assets, right? After the admission of the new partner, both the assets and the equity go up. So let's say Asia decides, you know what, Nick, instead of buying the $13,000 in ownership from you, I'll just bring in $22,000 of cash into the business. Partnerships love that. They're like, oh yeah, new cash. Yeah, we could always use new cash. So Johnny's balance 52,000, Nick's balance 26,000. Asia brought in $22,000 into the business. The transaction here, we debit cash and we credit Asia's paid-in capital account. In some cases, when that happens, bonuses get paid to the older partners of the business. It's kind of like the cost of doing business, right? So the older partners, Johnny and Nick in this case, will receive cash bonuses when the new partner joins, when Asia joins. The new partner, Asia in this case, may grant a bonus to herself if the business doesn't need the cash. If it needs the cash, then she won't give herself a bonus. Okay, so Asia decides, hey, listen, as a bonus for letting you guys join me as a partner, I'll pay you guys a bonus. So she makes an investment of $42,000 in cash into the business. Asia receives a 25% ownership interest in the new partnership. Any bonuses attributed to the existing partners is shared equally. So this gives Asia's balance is going to be 30,000. The way it works is we take the total equity of Johnny and Nick, in this example 78,000, plus Asia's cash investment of 42,000, giving the total partnership equity 120,000. Based off of the new partnership agreement, Asia's percentage of ownership is 25%. So we take 120,000 times the 25%, giving Asia a bonus, an equity balance of 30,000. So the partners agree. Go ahead, Asia.
So the new equity balance of that partner went from 42 to 30. Is that correct?
It went from, I'm sorry, I went the wrong direction on the slide. Yes. So that's correct.
Okay.
So Asia, you brought in $42,000 of new cash into the business. The partnership agreement stipulates that you will receive 25% ownership into the new business, right?
Okay, so I
So,
guess it's kind of like a fee to buy in a little bit.
yeah, that's kind of true. Yeah, that's the way of thinking about it. I know Nick likes the idea, but the way it works is we take Johnny and Nick's total equity amount, 78,000. We add your equity investment, 42,000, to their equity, giving the total partnership, the three partners, the total partnership equity is 120 with the three of you invested in the business. Okay. But because you, Asia, you own 25% of this new business, that means your equity balance is going to be 30,000. Okay. But don't worry, I'm sure you'll get bonuses along the way.
Okay.
And you'll probably even share in some net income. You know, the business is going to make money. You'll be fine. Don't worry. But yes, that's one way of thinking about it. It's kind of like buying into the business. You know. Good observation. Okay, so Asia brings in the 42,000 into the business. Now, the partners, Nick, Johnny, Asia, I don't know why you guys agreed to this, but you did. Is that Johnny and Nick will receive a bonus. Asia, I don't know why you agreed to that, but you did. That's what happened. So that's how you bought into the business, right? That was the agreement that you all made in the partnership agreement, is to give the original partners a bonus. So we did this. Asia brought in $42,000 in cash into the business. She's receiving a 25% ownership. She also agreed that the original partners will receive an equal bonus. So the way we calculate the bonus is the extra funds that Asia's bringing into the business. She's bringing in cash 42,000. Now remember, she owns 25% of the business. If the total paid-in capital balance of all three partners is 120,000, that means that Asia's paid-in capital balance is going to be 30,000. 120 times the 25% is 30,000. So we take the cash that Asia brings into the business, 42,000, minus Asia's capital balance of 30,000 equals $12,000. The $12,000 is paid out as a bonus to the original partners. The original partners share in that equally. So 12,000 times half is $6,000 per partner. So we debit cash, 42,000 into the business. We credit Asia's paid-in capital, 30,000. We credit a bonus paid-in capital to Johnny and a bonus paid-in capital to Nick for $6,000 each. Now, sometimes the agreement might be a little different. And, Asia's like, well, listen, if I'm going to give you guys a bonus, you better believe I'm going to give myself a bonus because I'm freaking awesome. That's what Asia said. I'm not making this up. That's what she told me. So Asia said, I'm freaking awesome. So I'm going
Sounds
to give
like
myself a
me.
bonus.
I would say that.
I know you would. So yeah, you're awesome. So you gave yourself a bonus. I don't blame you. I would have done the same thing. So we got Johnny, Nick, and Asia. They agree. They say, okay, Asia, I hear you. Yes, give yourself a bonus. You're awesome. That's so you give yourself a bonus. Great. So Johnny and Nick, they started with $78,000 paid in capital. Asia's going to bring in 18,000, giving the total partners $96,000 of equity. Asia's percentage of ownership, according to the partnership agreement, is 25%, which means that Asia will have an equity balance of 24,000. Don't worry, Asia's going to give herself a bonus because she's awesome. So the partners agree, yeah, we'll give you a bonus. So instead of each Johnny and Nick getting the 6,000, they're each going to get 3,000. So cash coming into the business, 18,000. Johnny and Nick get $3,000 respectively, based off of the additional paid in capital. The rest of the balance goes to Asia, 24,000. Now, over time, the partners usually will take some money out of the business. That's just normal. Partners will take money out of the business for whatever reason, but they want to take some money out of the business. No problem. This happens in one of two ways. Either the partner can the partner can sell shares of ownership in the business to another partner, or the partner can distribute cash and other assets to the withdrawing partner. I'll show you both ways. Let's say that Nick decided, you know what, it's been real, y'all, but it's time for me to retire from the partnership. So Nick decides, yeah, I'm done. I've had enough fun for a season of my life with this store, okay, this skateboard store that we opened up. So he decides I'm done. So he decides to withdraw from the business. He has a balance of $38,000 in his capital account. All right. Johnny has a balance of 84,000, and Asia has a balance of 38,000. The partners share. Remember, the partners share income and loss equally. So this means that Nick will receive the $38,000 of cash upon his leaving of the business. So we debit Nick's account, 38,000, we credit cash, 38,000 to pay Nick out. He didn't get a bonus, okay? He's out, he's done. So no problem, just cash his account out and he's good to go. That's one way of doing it. Okay. Another way of doing it is that the remaining partners can receive a bonus when Nick leaves the business. So that means Asia and Johnny would receive a small bonus. So we cash out Nick's account, 38,000. Nick is actually going to receive $34,000 when he walks away from the business. The remaining balance gets split among the remaining two partners equally. That's another way of doing it. So again, it all depends on the way that you all write up that partnership agreement. But that's how it would work. Let's see. Let's say a partner leaves the business and the bonus goes to the partner that's leaving. Sometimes that happens too. So this is where Nick makes out real well, okay? So Nick had his $38,000 balance. He's going to receive $40,000 when he walks out. He's going to receive a balance from both Asia and John. So 38,000 is what he has in the business, and he's going to receive $1,000 bonus from each partner when he walks out. Nice, right? So we debit Nick's account in full, 38,000. We debit Johnny and we debit Asia $1,000 a piece because you're being nice. You're going to give Nick a bonus when he leaves. Hey, I didn't agree to these terms. That was written in the partnership agreement. All right? Now, unfortunately, life happens, and unfortunately, one of the partners may become deceased. Oh, God forbid that ever happens to any of you. But unfortunately, it happens to all of us at some point in our lives. So, one of the partners doesn't make it through. Okay. When that happens, the partnership typically dissolves. But as it dissolves, the partner's estate is entitled to receive the partner's equity. Okay. An estate, what it means is the family of the deceased partner is entitled to receive the equity that that partner had in the business. That's nice. That's a good thing, yeah. All right. And so all that's done at settlement. They close out the books, determine the income or the loss, record the fair market value of the assets and liabilities, and then they settle with the estate, of the partner, the family. So liquidation. Partnerships can dissolve for whatever reason. You all decided to retire, one of them passes away, they decide that they're done, they quit. Yeah. So to dissolve the partnership, they first liquidate any remaining assets that are non-cash. You're going to sell the building, you're going to sell the equipment, you're going to sell all the non-cash stuff. Then you record the gain or the sale, gain or the loss on the liquidation of the remaining assets. All the partners get paid, all the liabilities of all the partners get paid out. And then anything that's remaining gets distributed based off of the capital balances of each partner. If there's no capital deficiency, that means all the partners have zero and there's no negative equity. They agree to liquidate the partnership. Asia, Nick, and Johnny decide to liquidate the partnership. And there's one outstanding accounts payable for $20,000, so they pay that off first using the cash, and then they distribute based off of the balance in the equity accounts, whatever's left over, right? The company just starts liquidating. They sell the land for $46,000 in cash. They distribute that equally among all the partners. That's nice. Yeah. So some agreements aren't that bad. They pay off that last debt, the $20,000, and then the remaining balances are paid out to the partners based off of what they have paid in. Sometimes there might be a point of capital deficiency, which means that one of the partners has a debt on their account for whatever reason. That needs to be satisfied before any remaining balances can be paid out to the other partners. So the partners paid the deficiency, and then the rest is distributed to the partners that don't have the deficiency. If a partner cannot pay their deficiency for whatever reason, then of course the other partners have to equally share in the loss, right? That's part of the partnership agreement. They have to share in the loss. So that's what this transaction represents. A couple of ratios. I can't let you guys go without a couple of ratios. So one is called a partner return on equity. It's where we take the partner's net income divided by the average partner equity. The average partner equity, we take the beginning balance plus the ending balance divided by 2. That's how you find the average. Any questions on partnerships? Well, I appreciate you guys keeping me entertained. And thanks for letting me use your names, Asia, Nick, Johnny. Appreciate you guys doing that. I was trying to make it somewhat fun anyway. Okay, just to kind of recap what's due on Sunday, and do a thank you for starting us off. I appreciate you doing that for us. Week 6. For the last chapter that we just discussed on short-term liabilities and payroll, you have a discussion board about payroll. Okay, it's a fun discussion board. I think you'll like it. Use some outside resources. Do some internet research, whatever. For the chapter 11 discussion, here's what I'm looking for. Asia started us off this is exactly how I want it to look. Nice long paragraph, some sources, external resources that Dewey used here. And then ultimately Dewey will respond to 2 classmates with full paragraphs. Okay. Now that has to be done by Sunday night. So 1 original response to the discussion prompt and 2 responses to your classmates. Please do this. Yeah, it's worth 5% of your total grade. Don't miss discussion boards because you don't like them. All right. I know you don't like them. Okay, I get it. But I want you to do them. All right. Get that 5% of your total grade. Please don't miss on something like that just because you don't like something. So 1 original response, and then 2 replies to 2 of your classmates. Full paragraphs, yeah? And then also, Sunday night, you have your Chapter 12 quiz, which is on partnership accounting. 5 questions, true, false, multiple choice. There are 2 attempts. Higher the 2 attempts accepted in the grade book. Any other comments, questions, or concerns? Okay, great. As always, you can email me, call me, set up office hours, whatever you need. I'm here for you. Okay? Email's always the best. Yeah, I'm pretty quick to respond. You know that by now. But thank you all so much for your time today. I really appreciate all of you and all the hard work that you're putting into this class. It means a lot to me. If you need anything, you know how to get me. Email me, call me, set up office hours, whatever you need. I'm here for you 100% of the time. And as always, stay safe, wash your hands, do the right things. I'll see you all again next Tuesday at 11 a.m. Have a wonderful rest of your day. Thank you so much. Bye-bye.